Ladies and gentlemen, the next session is Digitalization, Democratization, and the Future of Capital Markets.
So I'm really excited to be here. This is the third time, and it's really great to see how David and his team has grown this conference over the years. So congratulations to Zeta Global team. So today I have really incredible panelists, and many of them that I know over 20 years now. Anton, right? On the panel, we have Bob Niehaus, Anton Levy, and Paul Abdulhamid, butchering your name, sorry, Paul. And so I don't think it would be great if you guys can just introduce yourself, about your firm, and then we can jump into the question.
Sure, Imran. So Bob Niehaus, I'm the founder and co-managing partner of GCP Capital Partners. We're the original private equity group of Greenhill and spun out about almost 15 years ago. We do growth capital, a lot of fintech, tech-enabled business services. Zeta is one of our largest investments.
And the most successful one?
One of the more successful ones. Delighted to be here.
Anton?
Hello, hi. I'm Anton Levy. It's great to be here. I've been with a firm called General Atlantic for 25 years, co-president, and run our technology business there, which includes software and consumer internet investing. The firm's been around for 43 years or so, and we invest in mostly equities of businesses that are growing fast around the world. So relatively global investor in high growth companies at different stages.
Paul?
Paul Abrahimzadeh, been with Citigroup for 22 years, manage our equity capital markets franchise for North America. Equity capital markets really is in charge of structuring, valuing, and marketing companies either in the private placement market, IPOs, or subsequent financings. We work on offerings around the world, touching every major geography, and I spend most of my time in tech.
So today we have a group of people who has great experience in investing and the economy around the world. And I think we're joining this in a very interesting time, right? Over the last decade, we saw very strong growth, and now we're sitting here. There are a few things going on. Interest rate is 20 years high. I think today is at 10 years Treasury is 4.65%. We're seeing inflation, fairly stubborn inflation. Despite raising interest rates, relatively strong job market. We are seeing deglobalization. So what you guys are thinking about as you're thinking about the capital market or investing environment, what do you think, next 12 months, 24 months look like? And how does that, really ripple through the, Main Street or advertising world or in the employment sector? Paul, do you want to go first?
Yeah, I think we're constructive on the outlook. We are looking at consensus expectations for 12% EPS growth next year. That's positive. We've seen volatility collapse over the course of this year in the equity market. The market's expecting a 1% daily standard deviation. It was 2% a year ago, so the market looks much more investable. That being said, the market's priced to perfection. It's roughly a 10% premium to the last 10-year average on a price to earnings basis. And Imran mentioned rates. 10 years gone from 4% to 4.65 in 3 weeks. So cost of capital's gone up very quickly. Oil's now touching close to $100 a barrel. So I think we're going to have to contend with those two factors, and that's going to call into question earnings growth next year. Also got an election. That's going to be, I think, a headwind for capital formation in the second half of next year. But in general, coming out of the pandemic and then the readjustment last year economically, it feels like things look good for the next 12 months.
But how do you really think 12% growth when oil is almost $100? It cost me more money to buy a house, buy a car. How does the earnings grow? Is that means we're going to see more layoff to grow companies, grow earnings? Like, how are you thinking about that? Or the economy remains strong? Maybe I can follow up, and then I have a question for Anton.
Sorry. Yeah, I would just say I do think the market's expecting efficiency, maybe not immediately, but AI and technological advancement is going to lead to probably better margin, better profitability that could offset some of those costs. But again, this has been a very recent move in rates, very recent move in commodities, which could call into question 12% EPS growth next year versus 2% this year.
Right. So going back to investment world, Anton, you have been investing all the great companies, going back from Alibaba, Mercado Libre, and CrowdStrike, all these, really, really big companies. And what are you seeing on the investment world? What are you seeing the companies that you see on the board? How's the business doing? What's the outlook from those companies' perspective and from your perspective on investing?
So I can say a couple things. One is that I'm probably a little bit more sober than Paul on the investment outlook for the next 12 months. I think it's going to be a bit more challenging. I think you're in the middle of a multi-year correction. My view is you're probably, at least in the private markets, you're probably a third of the way through that correction. It's hard to be too precise. I think just the impact of higher rates, inflation, some of the things you've talked about, some of the geopolitical risks. I think you're early in feeling that for companies, unfortunately. I think actually the companies are doing pretty well. I think this year has been pretty good. To answer your question, the boards of the companies I sit on, actually business is pretty good. I think that's going to change though. I mean, I think that a lot of the behavior people were spending on travel and other factors like that, I think people are going to run out of money. I think borrowing costs are going higher. You're seeing credit card debt inch up. You're seeing delinquencies start to inch up. You're seeing rates for consumers. I think that stuff's starting to impact and pinch consumers, and as a result will impact businesses, which as a result will impact things like CapEx and software purchases and those kinds of things. So I think it's probably a good thing over 2 to 3 years. I just think the next 2 to 3 years are not going to be gangbuster growth years. I'm not saying you were saying they're gangbusters, but I think it's going to be challenging. I think it's on the positive side. I think the 5 to 10 year outlook is really positive for companies in terms of innovation, entrepreneurship. You mentioned deglobalization. I actually think the world's probably globalizing more so than ever, notwithstanding some of the China decoupling. We're seeing a lot of the companies that are, whether you're in Brazil or India, want the same kind of software and technologies that companies in the United States want. So I actually think you're going to see, the way we look at it, really continued globalization, even if some of the supply chains decouple in certain regions. So I think the 5 to 10 year outlook is very positive, but I think the 2 to 3 year outlook is more challenged.
So we'll come back to the globalization because that's a very interesting topic to cover. But I think you really raised an interesting question because I think a lot of people I talk to, they think, oh, we saw this big correction in the private market and now things will get better. And I'm kind of like in your camp that it feels like those are melting ice cube that is going to, we're going to feel the pressure over a couple of years. And because I think a lot of companies, increase efficiency and stretch their financing, and you're not going to see the full financing. And I think we're going to see the financing cycle happens next year. So actually, Bob, what's your view? Like, where do you stand in terms of what's going on in the private market and the companies that you guys have on your portfolio, or in terms of investment environment?
So I agree with Anton. I think we're only partly through a repricing and what I would call, frankly, a popping of a bubble. I think there was a bubble in private capital that the super low interest rates and some of the early successes, some of the internet consumer models created, for every Alibaba, 100 to 1 shots. And so there was a flood of capital that entered the market. A whole bunch of business models got funded that shouldn't have, that don't make money, that were funded based on revenue growth, not on a sustainable business model. There was some debt available. So I think we still haven't repriced the private market. Paul and I was asking him about the public markets, and he says, well, if you're already taking your company public, the market prices it every day. So you can see that it's down 10%, 15%, 20%, whatever it is from its high, or 30%. But a private company can be put their head in the sand. They can be a little bit of an ostrich for a while, the owners. And that's just starting to come. The other thing is that there's a real cutback in credit available. I'm in the mid-market. Anton's companies are generally a lot larger than ours. Ours would have a couple $100 million in revenue and 10 to 20 million of EBITDA, and we're trying to do a roll-up or usually organic growth in something like Zeta. But so I think there's a bunch of companies going to go out of business and merge. There's debt. The regional banks have pulled back significantly. The debt's down about a turn what you can borrow. And the valuations in the private market I don't think, aren't where they should be yet. And there's still a bit of a gap between where the owners they think it's the old price less 10%, and the buyer is looking at the new environment saying it's the old price less 30%. So, and it's not until the owner needs to raise new capital, usually there's price discovery and what clears the market.
Correct. So one topic that everywhere I hear in artificial intelligence, I cannot go to a lunch or dinner in New York City or anywhere. that I don't hear people talking about AI. I think last time I heard people talking about this topic was crypto, and before that, 2001 bubble. So is AI a bubble? Is it a real? Anton, you talked a little bit about, maybe go to you first. What's your view on artificial intelligence? Are you guys making investment there? Are you seeing your portfolio companies are making investment? What's your thought on AI?
So I think you're in a bubble, particularly along the early stage startup world in terms of AI. I also think the technologies is real. I think there's going to be a big productivity boom. So a lot of knowledge workers are going to be a lot more productive because of the tools. And I think what will be very maybe different about this wave of productivity is it won't just be traditional knowledge workers, but I think it's a lot of creative workers as well. I think things like movies and music, and I think it's going to have a bunch of impact in a lot of the creative professions, even some of the marketing stuff that goes on in this room, a lot of the creative side. I think that'll be enhanced and it'll make people much more productive and efficient. But that's how I view it. I think it's a massive productivity wave that's coming, but it's early. I think a lot of the companies, the business models is nascent. I think the differentiation of a lot of the core, particularly on the generative AI side, a lot of the core technologies, I think there's run the risk of becoming commoditized pretty quickly. A lot of the open source stuff is almost as good as the private company stuff that exists. And I think a lot of the beneficiaries of it today are a lot of the hyperscalers that are providing a lot of the training technology. So I just think it's early. I think you're in the first inning. I think it's going to go through a classic wave of lots of hype, lots of excitement, lots of funding, overvalued. There'll be a couple of successful companies, and could be very successful companies that come out of that. But then there'll be a period, people will notice it here, I think, where people are like, oh, look, that's another bubble, and it's not interesting. That's probably right when it's getting interesting. And values will come down, and then real businesses will start to get built with business models and profits and unit economics and those kind of things. And that'll be a great time. It's a little bit what I think crypto is actually blockchain's going through right now. Right now it's like, oh, blockchain's not interesting at all. Crypto's not interesting at all. I know there's the zealots, but for the mainstream, most people don't think that's interesting. And actually, now I think is actually some really interesting stuff and real businesses that are starting to emerge. I don't think it's going to live up to the old hype, but I think there's some really interesting businesses that are emerging in some of that stuff. And now's the time where you can get reasonable deals, and risk reward is interesting and the like. I think AI is going to go through a similar wave. Right now, it's just on the hype cycle. I mean, it's literally the definition of a hype cycle. It's on the cover of every magazine, every newspaper. To your point, every dinner conversation.
Every dinner.
So I think you're in the middle of that. But I do think over time it really will be a massive productivity cycle. I'm not sure I believe this stuff that says it's going to put everyone out of jobs and all that. I don't think that's true, but I think it will be a really big productivity enhancer.
Bob, what are you seeing in your companies?
Our companies aren't big enough to really take advantage or attack it yet. But we're still, one of the great secular growth drivers of this economy for the last, really since World War II, has been the research and development that this country does, attracting the best minds from all over the world, and we're the leader in almost every new technology. And so we're still funding software companies that are automating and taking manual labor out of supply chains and customer interactions and all that sort of stuff. And AI is just the next wave after that, and it'll come. But as Anton said, I'm very bullish long term, just because we remain the world's leader in technology. Technology drives growth, it drives innovation, and AI is just another one of those tools that's going to. But it's stuff is super expensive. The startup capital valuations are very high.
So let's talk about it from a public market perspective, right? I think obviously we talked about what can happen in the short term, but I think if you look at last 30 years, when there was a pretty significant productivity cycle improvement, right? Going back in 1995, when you saw commercialization of internet, brought significant productivity gain and drove economies significantly. Same we saw that in 2007 with iPhone, drove completely new economy, helped the stock market significantly. If AI going to be a significant driver of this productivity improvement, and should you invest in your 401k for next decade aggressively? Paul?
I think similar to what Bob was saying, we've done dozens of calls with investors across virtually every demographic. So mutual funds, hedge funds, family offices, crossovers, growth equity. And the feedback's been consistent. They've all looked at AI. They all know that it's going to be a great 5 to 10 year trend. and they come out of all the meetings with the various AI startups, and their conclusion is, I've got to put more money into the Magnificent Seven. I've got to go with the biggest tech players, mega caps that can invest, because it's too difficult and too early to take a bet on the technology with a lot of the startups.
And the big guys are also the landowner, right? You get the money, and then you put the money on cloud computing.
Exactly right. So I think the market believes in AI and what it's going to do, but where they're placing their bets today is probably a safer cohort within the ecosystem, which is really the largest companies that can invest and really get a look at all of the emerging AI companies and pick the best and then groom them and deploy capital. And you've seen some very big names year to date where that's come to play.
So I guess the next question is, we always talk about positive side. Let's talk about the negative side. Like everything comes with some baggage. You know, internet did the same thing, iPhone did the same thing. So what do you think? You know, if you listen to Elon Musk, he will say AI needs to be regulated, and Mark Zuckerberg is probably a little bit on a different camp. What's your guys' view is, how does AI disrupt the, had a negative impact on capital market or society in general? How should we think about it? Should we be scared of AI? Who wants to take it? Anton?
My view is no. I mean, today, there's lots of, people mean a lot of different things when they say AI. There's a lot of, people watch the movies and, where the robots take over the world. The current generation of generative AI, that's just not even how it works. I mean, it's predictive technology where it takes, it's a massive predictive technology where it takes in lots of data and says, what's the way I think the next sentence is going to be. It wouldn't even make sense for robots to wage war or those. So I don't think those, at least with the current generation of what's been talking about on the AI, makes any sense. I also think if you look at a lot of technologies over time, there's been lots of worry when they come out. When the TV came out, people were nervous that it was going to completely brainwash society. If you actually go back to when the bicycle came out, people were worried that it was going to create lots of problems, which I won't bore you with. But people were very nervous in certain cities that was going to what that was going to create for how people would interact with different societies and stuff. So every time, internet, same thing, phones, same thing. And look, there are some consequences. I mean, social media is not perfect, and we know some of the impact that it has on kids and the like. But generally, it's been a massive productivity enhancer, and the net benefit has been really, really, really large. I think this is another, like the spreadsheet. I think the spreadsheet, the word processor, I mean, these things have been massive productivity tools for wide swaths of the population. I think this will be another, maybe even bigger, like a combined spreadsheet, word processor type innovation. And I think that the benefits will massively outweigh the costs in this case. It's just going to make everybody much better. I think there's some negatives you can think about, like education. A lot of kids are using this to write papers and stuff like that. That needs to be managed so people can think on their own and those kinds of things. But I think those are manageable, and already people are putting in protections to manage that.
So, Bob, you are on Zeta Global board. Zeta has done pretty amazing job, using data to drive ROI for the marketers. And we saw, how much data becomes so powerful. With AI, we're going to have even more power, right? So, do you think it spread misinformation? We saw the misinformation, or use AI on a negative context on political campaign.
Well, I think there's a lot of potential damage that social media, AI, targeting information does in general. I saw a stat earlier today that the average teenager gets 400 notifications on his or her phone a day if they're following friends on Instagram and other social media. And it's just disruptive. You hear, I think there's a crisis in education to the extent that kids who have concerned parents who control and manage how much social media they absorb. But I think the risk is we end up with a bifurcated population with really well-educated people who have been disciplined enough that they've continued to learn the analytical skills you need, and there's going to be others that rely on AI, which is kind of a supercharged Cliff Notes or Spark Notes that kids use to cheat when they were told to read a book and write a report about it, and they get the Cliff Notes and write it. And so I think we have to be careful. I think there has to be guardrails for kids. Fortunately, my kids are all grown. They miss the Instagram, Facebook part of life, and they're in their 30s, but I got grandkids.
So they're on TikTok now? No, I'm just kidding.
Yeah, and I think it's a significant issue. It's a societal issue that more so than the economy. I think the economy is going to do great, but I think and because of the automative aspects of AI, you know, I'd hate to continue to have a portion of the population who just don't have the skills that can adequately contribute to a modern economy.
Got it. So I want to go back to this whole deglobalization, and I think Anton brought a very interesting point. So I think, so here's the premise of the question, right? So I think if you look at what's going on in the world right now, you have a war in Russia and Ukraine. You have China, where they fundamentally changed their course, under Xi Jinping. How even today a public company stock was suspended because the CEO went missing. You can potentially argue that India has a populist prime minister and even sending their spy to kill people in Canada, a Canadian citizen. Why do you feel comfortable that we're going to continue to see more globalization in a world where we are seeing the sentiment for populism is rising across the world, not only in the United States, across the world, nationalism is rising. So why do you think that investing globally makes sense? Anton.
Yeah, so I think it depends how you define it. I do think supply chains are going to change, and they are changing. I think you're seeing a lot of nearshoring from chip making and the like, moving from Asia and China and Taiwan to Mexico, United States, and stuff. So that is happening on supply chains for sure. But I think the fundamental, when I use the word globalization, it's how connected is the world in terms of information, tools, products. And it's only getting more connected in terms of people traveling, digital information, data, friends, communications, TikToks, Instagrams. I mean, that's all happening in real time around the world. And if you look at a lot of the products, when they're successful in one region, products are increasingly quickly successful in other regions. And so there'll be some pariah regions. We have some extreme ones like North Korea, Iran. There are some pariah regions. We'll see where China ends up. Maybe China will become one of those. I hope not, but that's not completely off the table today. So that said, for the regions that participate in the global economy and are global players and are good actors and actresses, those players, they're going to be completely much more integrated, in my opinion. So when I look at things like selling software or selling consumer goods or selling things like makeup or different restaurants and food, I think that's going to increasingly, you're going to see that increasingly globalized with the friendly nations of the world. And I think you're seeing it. And I think we see it a lot across our software portfolio. Look at even something like TikTok today, which is, Chinese based company. I mean, how quickly it became used everywhere, all over the globe. And a lot of that content is shared. I mean, it's, French kids making TikToks are viewed in Norway, and it's increasingly global. And I know there's regulatory stuff, but I think that that's even for a Chinese company. I think that opportunity is only going one way and not reversing.
Paul, Citibank obviously invests globally. What do you guys think, and how are you guys thinking about globalization and managing the global risk?
Well, I agree with Anton's perspective on the long term and the more global aspect of the economy. I would say, this moment in time does feel different from an investing perspective in the public markets relative to what we've seen over the last 15 years. If you think back to 2010, we raised $70 billion for Petrobras at a $350 billion valuation. I think it's now sub $100 billion. We worked on the Alibaba IPO together, $25 billion IPO, biggest in history before Aramco. We were pricing Chinese ADR IPOs in the US that traded up 100% consistently week after week back in 2012. And you look at today, and the capital by default has come back to the US, which I think for everybody in the room, if you're operating a US-based business, is great for attracting capital. There have been too many slip-ups when you think about cancellations of large IPOs overseas, when you think about industries in emerging markets that have been canceled by regulators at a moment's notice that have caused real losses for US-based investors. I think that's the risk that at this point in time, as you've got this re-emerging Cold War with China, that you're seeing a retrenchment and a focus on the US or developed markets where the US has allies. But the investors we speak to, they're not seeing a lot of growth in Europe. They're scared about a lot of the government policies in Latin America. And Asia has been a pretty tricky place to invest given the US posture with China and Taiwan. So I agree with Anton. I think the economy will keep getting more global over time. But right now, there's delineation that's bringing capital back to the US, at least for the time being.
Got it. So we have 3 minutes left. So I'm going to go like rapid questions, starting with Bob. So next 12 to 24 months, if you have to invest whatever number you pick, what sector you think makes the best sense to make investment?
I think any business that uses current technology and all its accompaniments to automate, take cost out, provide more informed decision making, more customer attention, and that's can be software. It could be digital marketing companies like Zeta, but the technology is relentless and marches on. And even though we're going through a repricing of what a lot of these assets are worth, anything that uses technology to lower costs, increase efficiency, and reach more people in a cost-effective way.
Anton, similar question. If General Atlantic has to invest whatever capital you want, what sector you guys are most excited about?
I think it's not. I mean, I know
12 to 18 months.
I know you're looking for one specific answer, but I think for us it's much more the business model and a flywheel, and we continue to see amazing businesses getting formed with great products, great business models where there's a network effect or a marketplace like sentiment that creates real breakout technologies. And we continue to look at those, whether it's in a healthcare business, a financial services business, or a traditional vertical software business. So I'd say probably a bit more business model focused and moat focused, as much as healthcare versus financial services versus energy.
I'll trick you, Paul. I'll ask a different question. What do you think happens to the market in the next 12 months? Higher or lower?
Our firm view is 15% upside.
15%.
But I think the quantum of that upside is going to get called into question based on rates and inflation, which is looking higher in the past few weeks. So I think market's higher. I think you're going to see a lot of volatility in the second half of the year around the election. Like I said, the market is trading 10% expensive relative to the 10-year trailing average. But a lot of investors we speak to see systemically higher multiples because of better margins due to things like AI. So I think market's higher 12 months from now, probably put it 10 to 15%.
All right. With that, we are out of time. So thank you so much, gentlemen. I really appreciate it. And thanks, everybody here.